We are taught in school that the Great Depression began on a single Tuesday in October 1929. We are told it was a sudden, tragic accident, a structural failure of the stock market that caught a prosperous nation by surprise. We see the grainy footage of men in fedoras jumping from windows and bread lines stretching around city blocks, and we treat it as a ghost story from a distant, less regulated past. But this is the version of history written for children. It is the version that ignores the cold, hard mathematics of human greed. If you want to understand why the world broke in 1929 and why the same cracks are forming under our feet today, you have to look past the ticker tape. You have to look at the ledger books of the 1920s, because the Great Depression wasn't a sudden heart attack. It was a slow-motion overdose. This is the story of the ultimate easy money trap. It is the story of how a generation of investors, drunk on the success of a new industrial age, mistook a debt-fueled fever for a permanent state of health. It is a cautionary tale that echoes loudly in our modern world because it demonstrates a brutal financial truth. You cannot build a skyscraper on a foundation of air. To understand how the greatest economy on earth went bankrupt, we must travel back to the summer of 1927. To the outside observer, America was a titan. It had emerged from the First World War as the world's creditor. Its factories were humming with the sound of assembly lines, and for the first time in history, the average man could own a car, a radio, and a piece of the future. But beneath the surface of the roaring 20s, the foundation was rotting. The prosperity was not built on productivity. It was built on a drug called margin. In the 1920s, the stock market became the first true lottery for the masses. People weren't investing in companies. They were gambling with money they didn't have, using 10-to-1 leverage to buy into a dream that only stayed alive as long as the next person was willing to pay more. The investors of 1929 thought they had conquered the business cycle. They thought they could buy the appearance of wealth using other people's money. They didn't realize that every loan is a tether, and every margin call is a hammer. The crash wasn't the cause of the depression. It was merely the moment the ledger finally balanced itself. To understand the crash of 1929, you have to understand the architecture of the trap. In the mid-1920s, the American financial system underwent a radical transformation. It stopped being a utility for moving capital to productive businesses and became a casino designed to manufacture the illusion of wealth. The engine of this transformation was a mechanism called call loans. At the height of the boom, an investor didn't need a fortune to buy stocks. They only needed a 10% down payment. If you wanted to buy $10,000 worth of Radio Corporation of America, RCA, stock, you only needed $1,000 of your own money. The other $9,000 was provided by your broker, who in turn borrowed it from a commercial bank. These were call loans debts that the lender could call in at any moment, demanding immediate repayment. This was the financial virus that infected the American middle class. It created a feedback loop of artificial demand. As more people borrowed money to buy stocks, prices rose. As prices rose, the value of the collateral increased, allowing investors to borrow even more. By 1928, the amount of money lent to brokers for these margin trades had surpassed $5 billion, more than the total value of all physical currency in circulation in the United States at the time. But the rot went deeper than the retail investor. The banks themselves were playing a double game. In the 1920s, there was no firewall between commercial banking and investment banking. The same institutions that held the life savings of farmers in Iowa were using those deposits to fund the speculative frenzy on Wall Street. They were lending the public's bread money to the gamblers at the craps table. The Federal Reserve, the supposed guardian of the system, watched the fever rise and did something even more dangerous than nothing. They kept interest rates low. Just like the British Empire in the 1920s trying to maintain the gold standard, the Fed was obsessed with the appearance of stability, while the reality was disintegrating. They feared that raising rates would pop the bubble and cause a recession. So they chose to keep the cheap money flowing, effectively pouring gasoline on a forest fire. The investors of 1929 believed they were participants in a new era. They were told by economists that stock prices had reached what looks like a permanently high plateau. They believed that the old rules of gravity, that what goes up must eventually be paid for, had been repealed by modern technology. They didn't realize that they weren't building wealth. They were just passing around us. Debt that was growing faster than the economy's ability to pay it back. The ledger was becoming increasingly lopsided. On one side, you had the soaring prices of the Dow Jones. On the other, you had a mountain of call money that could disappear in a heartbeat. The system was no longer a market. It was a giant margin account, and the margin call was coming. History books like to focus on the panic, the screaming men on the floor of the New York Stock Exchange, and the sudden plunge of the Dow. But to understand the Great Depression, you have to understand the liquidation. By September 1929, the market was no longer driven by earnings or industry. It was driven by gravity. Professional speculators, the ones who actually looked at the ledgers, realized that the dividends of companies like General Electric and U.S. Steel could never justify their share prices. They began to quietly exit. But the millions of retail investors, the ones who had mortgaged their futures on margin, didn't see the exit signs. They were too busy watching the ticker tape, waiting for the next surge. The first crack appeared on Thursday, October 24th. Black Thursday. A wave of selling hit the floor, and for the first time in a decade, there were no buyers. This is where the margin trap snapped shut. When stock prices drop, the broker doesn't wait for you to recover. They issue a margin call. They demand that you provide more cash to cover the loss. If you don't have the cash, and in 1929, nobody did. The broker is legally obligated to sell your stocks at any price to protect their own loan. This created a doom loop. Selling triggered more price drops. Price drops triggered more margin calls. Margin calls triggered more selling. By the time the dust settled on Black Tuesday, October 29th, the market had lost $30 billion in value, more than the total cost of the United States' involvement in World War I. But the real tragedy wasn't in the stock market. It was in the banks. Remember, the commercial banks had lent the public's deposits to the brokers to fund those very same margin loans. When the brokers defaulted, the banks were left holding a mountain of toxic paper stocks that were now worth pennies on the dollar. The money that families had saved for decades wasn't just gone from the market, it was gone from the vaults. The news spread like a virus. People realized that if their bank had gambled on Wall Street, their life savings were at risk. This led to the bank run, the most terrifying phrase in the English language for an investor. Thousands of people lined up outside banks, demanding their cash. But because the banks had lent that money out, the vaults were empty. In the style of the Ottoman debt trap or the British liquidation of India, the American people were discovering the brutal reality of the ledger. Their wealth was merely a digital entry in a system that had no actual liquidity. Between 1929 and 1933, over 9,000 banks failed. The easy money of the 1920s had vanished, replaced by a cold, hard vacuum. The Great Depression didn't happen because the world ran out of resources or factories or workers. It happened because the world ran out of trust. The ledger had been balanced, but the price of that balance was the destruction of the global economy. The genius of the American investor in 1929 was his belief that the Atlantic Ocean was a firewall. He believed that even if the skyscraper of Wall Street collapsed, the rest of the world would remain standing. But in the modern industrial world, the ledger is a closed loop. There is no such thing as an isolated bankruptcy. By 1930, the American virus had become a global pandemic. To understand why, you have to look at the flow of capital after World War I. Europe was a continent built on a foundation of American credit. Under the Dawes Plan, American banks lent money to Germany so that Germany could pay reparations to Britain and France. Britain and France, in turn, used that money to pay back their own massive war debts to the United States. It was a giant international merry-go-round of debt. As long as American banks were flush with cash, the system worked. But the moment the margin trap snapped shut in New York, the flow of dollars stopped. American banks, desperate to cover their own losses at home, didn't just stop lending to Europe, they began calling in their existing loans. Germany was the first to fall. Deprived of American credit, the German economy didn't just slow down, it evaporated. Unemployment exploded to 30%. The middle class, who had already seen their life savings wiped out by hyperinflation a few years prior, now saw their very survival threatened. This wasn't just an economic crisis, it was a psychological liquidation. It was in this vacuum of despair and empty cupboards that a fringe political movement led by an Austrian corporal began to look like a solution. But the most significant casualty was the British Empire. For a century, the British pound had been the world's anchor, the gold standard that everyone trusted. But as the world economy shriveled, nations began to retreat into economic nationalism. They put up trade barriers, raised tariffs, and tried to protect their own industries at the expense of their neighbors. In 1931, the pressure became unbearable. Britain, the master of the global financial order, was forced to do the unthinkable. It abandoned the gold standard. It admitted to the world that it could no longer back its promises with metal. The message was clear. The old world order was dead. This is the lesson for the modern investor. When the great liquidation begins, it doesn't stay in the asset class where it started. It flows through the pipes of the global banking system, seeking out the weakest link. In 1929, that link was the German industrial heartland and the British imperial treasury. Today, the pipes are even more interconnected, and the debts are even larger. The Great Depression teaches us that in a globalized economy, you aren't just betting on your own portfolio. You are betting on the solvency of every bank, every government, and every ledger on the planet. We are often told that the Great Depression ended because of the New Deal, or because the Second World War restarted the engines of industry. We are told that the government stepped in, spent money it didn't have, and saved capitalism. But if you look at the ledger, you see a different story. The Depression didn't end because the debt was managed. It ended because the debt was incinerated. The world that emerged in 1945 was not a continuation of the world of 1929. The old empires, the British, the French, the Ottomans, had been liquidated. Their debts were so vast that they could never be repaid in real money, so the world moved to a new system, the Bretton Woods Agreement. This was the moment the US dollar became the world's reserve currency, backed by the only thing left standing American industry and the gold in Fort Knox. So, what does this teach the investor today? The first lesson is that liquidity is an illusion. In a bull market, everyone believes they can sell their assets at the market price whenever they want. But 1929 proves that when the exit door is small and the crowd is large, the market price doesn't exist. There is only the liquidation price. If you are playing with leverage, you aren't an investor. You are a tenant in a house owned by your broker, and he can evict you at any time. The second lesson is the ledger of reality. Governments today, much like the British in the 1920s or the Soviets in the 1980s, love to use easy money to paper over structural rot. They lower interest rates and print currency to keep the appearance of growth alive. But as the Spanish Empire learned with its silver, and the Soviets learned with their oil, you cannot print productivity. You cannot build a sustainable future on a foundation of debased currency. Today, global debt levels are higher than they were in 1929. We live in a world where the margin trap has been built into the very fabric of our sovereign states. We are told that this time is different because we have digital tools and central banks with infinite checkbooks. But the math of the ledger is indifferent to technology. The Great Depression teaches us that the market is a patient creditor. It will let you run up the tab for a decade, or even two. It will let you believe that you have conquered the business cycle. But eventually, the margin call always comes. And when it does, the only thing that matters is not what you thought you owned on a screen, but what you actually hold in your hand. History doesn't repeat, but the ledger always balances. And in the 21st century, the red ink is starting to run very deep. This is the Wealth History Tales channel. Subscribe now to stay ahead of the curve, because when the history books are written, you'll want to be among the few who saw the liquidation coming.